Hello and welcome back to All Things Money. I'm your host, David Blain. During this segment of the show, we're going to give a really good overview of what I call the investment decision-making process. Now, obviously, we handle our clients' investments, and so I'm going to go through the process. The first step that you go through is to determine whether to do it yourself or not. Now, once you get past that decision, the next 4 steps are the same steps that we follow when designing investment portfolios, when designing our own investment philosophy, and so I'm going to cover those with you. The first step you as an individual has to do is determine whether you want to be a do-it-yourself investor or hire someone. Now, let's talk a minute about hiring someone. Obviously, I'm very biased. If you hire someone, I highly encourage you to find what's called a fee-only advisor, like our firm, a member of NAPFA, National Association of Personal Financial Advisors, that take a fiduciary oath. They operate as a fiduciary on your behalf. Now, there are some fine brokers and other people out there. This is not meant to disparage other ways of doing business, but we happen to think that going out and finding someone that charges you a flat fee, or a lot of times they charge you a percentage of the money that they manage, that has some credentials. You know, they're a certified financial planner, they're a chartered financial analyst like me, a CFA. I mean, it's a 3-year program that most people, it has about a 20% pass rate. Having somebody that has the educational background, the experience. I remember when I was just starting out in the industry, I used to carry around a little advertisement with me that I cut out of the paper. It was an advertisement for a major wirehouse, Merrill Lynch, and it said, come be a Merrill Lynch broker. No offense to Merrill Lynch people, but it said, come be a Merrill Lynch broker out there. No investment experience necessary. And I mean, they're recruiting for salespeople. They want people that can go out and gather assets and bring money to the firm. So if you're not going to do it yourself and you're going to hire an advisor, of course, we suggest that you hire a fee-only advisor. In fact, on our website, dlblain.com, you will find some very useful information, whether it's authors or someone else, some very useful checklists to use when looking to hire an advisor, things to ask, things to look for, that sort of thing. Now, if you're trying to decide whether to do it yourself, of course, we think that the majority of people, 98% of the population out there would be best served with a true fee-only fiduciary financial advisor. Now, there are some people that try to do it themselves and do very well. A lot of times they happen to be lucky. With investments, just like the medical profession or even cars today, most people go to a professional to have their medical care looked at. You don't need a doctor to prescribe you an aspirin when you have a headache, but if you have a headache for 2 straight weeks, you may want to go see a physician. Well, we feel the same way, that markets are very complicated today. There's a lot of conflicting information. The media does the individual investor no favors whatsoever, and I would even lump the Wall Street Journal into this. I read the Wall Street Journal occasionally, but magazines and CNBC and all these are designed to get you to buy their product, watch their show, buy their magazine. And so to come out with some boring type investment advice that doesn't change every month, how are you going to sell Money Magazine if it says the same thing on the cover every month? Buy a diversified portfolio of different asset classes and hold it for the long term. That's boring. It's not going to sell a lot of magazines. And so the biggest danger when someone is doing it themselves is allowing their emotions to get in the way of their investing success. And so we feel like having that neutral third party, that certainly we care about our clients' goals and aspirations, but we're there as sort of a break on the emotional cycle, to break that emotional cycle of fear and greed, which is what gets most people in problems. So if you have complete control of your emotions and watching your investments plummet in October of 1987, 20% in one day does not cause you any anxiety or doesn't faze you, maybe you're a do-it-yourself investor. If watching your portfolio decline from the peak in October of 2007 to March of 2009, and you don't panic and sell out everything, then maybe you're a candidate for do-it-yourself investor. If not, we would suggest that you find a good fee-only advisor that knows what they're doing, that is confident in their strategies, that can help you obtain your long-term goals. Okay, so that's the first decision you have to make. Do I want to be a do-it-yourself investor, or do I want to hire somebody to help me? And once again, if you're going to hire somebody to help you, we recommend that you find a fee-only advisor like my firm to help you. Okay, so that's enough on the first decision. The second major decision that you have to make, whether you're doing it yourself or working with an advisor, is determining your broad, what we call asset allocation mix. And what that is how you divide your money up between stocks, bonds, and cash. Now, I realize there's all sorts of variations of those three categories of investments. There's hedge funds, and there's real estate, and there's private equity. Well, we're not getting into that right now. Right now, we want to determine how much do you want allocated to growth, which would be stocks. How much do you want allocated to stability in your portfolio and maybe a little bit of income? That would be bonds. And you have to determine how much you want allocated that's going to lose money guaranteed after inflation, which is cash. You probably see a bias against holding a lot of cash. After inflation, you're guaranteed to lose money. But anyway, that's the main decision, is how much in growth, stocks, how much in volatility reduction, pays a little income, bonds, and how much in no return but no volatility, cash. And the way you make that decision is you look at certain things. You look at your risk tolerance. If you get panicky every time, the market goes up and down a little bit, you probably don't want to be invested in all stocks. In fact, we would never recommend anyone be invested in 100% stocks, because adding a little bit of bonds to the mix lowers the volatility such that your terminal wealth at the end over the majority of time periods is actually higher than investing in all stocks. I don't want to get sidetracked on that today, but that's the second main decision you have to make, is that asset allocation decision. Okay, well, we're out of time for today's show. We'll pick up on this and a few more decisions that you have to make next week. So for All Things Money, I'm David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.